Hello again, everyone. John Flynn here from Flynn Real Estate, serving Southern Ontario. I'm based out of the Niagara region, and here again to give you my honest and professional opinion regarding the 2022 Canadian housing market. This week, I'm going to talk about rent prices, the statistics from a good few areas, not all, and of course, the immigration, 500,000 new immigrants. I'm going to touch on that quickly too. Let's start this off with the rent prices, and I'll tell you what I've been seeing. But let's first start in the States. Here's a few headlines. Rent got cheaper in September. Here are the 10 US cities where it dropped most. Inflation gauge doesn't fully capture cooling rent growth. Cracks may be starting to show in the rental market. So, of course, those of you in Canada, you know rent prices have increased dramatically. They've gone up, what, 20, 30%, depending on where you live. And it's hard to believe that they may be dropping, but I think we're at the start of it. They're a lagging indicator behind the house prices. And I think we've reached the peak, at least for now. And I'm going to show you some data to support that. Here is a Canadian headline. Toronto rents keep going up, but some nearby cities are now seeing price declines. So again, we have seen it. And what sparked my interest in this was I see we call it the hot sheets. So we get the daily and weekly hot sheets on our system, and it gets all the new listings and all the reductions. And I see a lot of rentals or leases on there that are getting price reductions. So yeah, I did some research, and just in my board, the Niagara board, the whole Niagara region, there's 415 active listings when I did this research. This was just in the last couple of days, and a third of them have been reduced. So it's pretty significant when you see a third of a certain category of listings getting reduced. And just today, I talked with my leasing manager. Her name's Allie. We, talk almost daily. And she said, yeah, it was weird in the last month or so. She's had to reduce a lot of the list prices. And then, of course, I received a call from another client asking me why his place isn't leasing. And again, this is not just a problem with my business; it's all right, because a third of places have been reduced. So, of course, let's see some data to see where things may be at. So this is from Ontario, the ITSO, my normal area, everything surrounding GTA, but just a few smaller areas or a few areas that aren't included, but most of the suburban areas surrounding GTA, Kitchener, Hamilton, Waterloo, Niagara, lots of places. So here is the average rented price. And you can see it looks like it peaked in October, which is, 6 or so, a little bit more than 6 months after the peak of the prices, right? So again, it's a lagging indicator. We've seen the prices, max out, and now I think we're going to see the rental prices max out. They are absurdly high, 20, 30% over last year, but I think they might be, maxing out at this point. The second chart here, this is the very interesting one. This is the list price of the average rental. In August, it was $4,300 a month for the average place and this is all rental places in Ontario, not including GTA. But we've come down to the average asking price or list price of $3,500. So it's a 16% reduction from August. So of course, people were over asking. The rent prices aren't sustaining the sale prices. So we're seeing this, tug of war now with the tenants and the landlords, and they're not sustaining the rents. So again, they are absurdly high, but I think they've maxed out, and we'll see if they drop. It's not uncommon for rents to drop, and we'll see how much, right? Next, we're going to move on to statistics starting in Vancouver. So Vancouver, inflation interest rates create caution in Metro Vancouver's housing market. And you can see here their sales for October are down 45%, over 45% from the previous October, 2021. And Vancouver has actually got it's a very odd market, right? It's third highest real estate prices in the world. So again, this is not a normal market by any means, but we're seeing, a very volatile market here. Some prices are up, some are down. And of course, spring and fall was good. So the fall was the good time. And let's see how that played out. So detached is down 3.5% month over month. And actually a correction for my last month's stats for September, I said it was up 0.6%. It was actually up 6%. So they went up 6% in September, and then they went down 3.5% in October. So yeah, again, very volatile. 12.7%, they're down from April, or from the April highs, 279,000. The attached market is up 9.5% month over month, which is again a pretty wild swing, and down 6% from the February peak, or 77,000. And the apartments are up 2.5% month over month and down 9.1% from the February peak, again 77,000. So I thought I'd have a little fun with this data. And on this graph, you'll see I notice an ascending broadening wedge, which is a bearish pattern. And you can see there it touches twice on the top, touches more than twice on the bottom. The support line there on the downside, I estimated that's going to be about 1.8 million. And yeah, we'll see if that plays out. But you can also make an argument that there is a head and shoulders pattern, either a small one right at the end or a bigger one. But yeah, we're definitely seeing some indicators or some patterns form on that data. You guys can let me know in the comments what you think and if you have any input to that. Now on to Calgary. Sales remain stronger than pre-COVID levels. October sales eased compared to last year's levels, mostly due to slower activity in the detached sector. Calgary hasn't seen the same degree of pullback in housing sales like other parts of Canada, thanks to persistently strong demand for our higher density product, said CREB Chief Economist Anne-Marie Lurie. While our city is not immune to the impact that inflation and higher rates are having, strong employment growth, positive migration flows, and a stronger commodity market have helped offset some of that impact. So, of course, Calgary, they do have migration. Like a lot of people have left Ontario to go that way. Same with their oil industry. The oil prices are high. The commodity prices are high. So, of course, they're doing well for that. And just general employment overall. So looking at the city of Calgary, of course, the benchmark is trending down still. Inventory, it's mediocre. It's not the greatest. In sales are still down, but they're not rock bottom. Nothing much has really drastically changed in the last month from that. The months of inventory has declined just a bit, so there is a pullback in inventory there, which I'm sure helps prop up the prices. And the city of Calgary total prices, or the average total price, 2% it went up month over month, or $10,000, and it's down 5.4% from the February peak of $29,000. So again, Calgary didn't increase like the rest of the country. And if we look at this graph and we look at this year just 3 months back, nothing much has really changed from 2018, right? So they're very consistent. When the rest of the country is going up, sometimes they're going down, and when the rest of the country is going down, they remain strong. But they've been pretty consistent over the last 5 years in their growth and their prices. So the potential for the downturn is a lot less than it would be in Ontario and Vancouver because of their growth. Okay, on to Toronto, Treb. So they're down 50% or almost 50% year over year from October 2021. And from the previous month, its sales have been flat. The average sale price is again down 5.7% compared to last year, but it is up just a touch or remained flat month over month, 0.3%. And it's 18.4% from the February peak, 245,000. The number of listings is down compared to October last year. And yeah, it's the sales to new listings ratio is also down compared to last year, which again is not a big surprise. And days on market continues to creep up, but it's up year over year, but nothing drastic there. Now on to Quebec. Montreal. October confirms a deceleration in the price decline despite a sharper slowdown in sales. And for Quebec City, the headline reads, "The Quebec City market remains resilient in the face of rising interest rates." So the province of Quebec is up 1% month over month. That's $4,000, so pretty much flat. And it's down 14.5% from May. Nothing much has changed from the previous month. This is for, single family, and this is median prices. In the province of Quebec, the condominiums are up 0.6 or 0.5% approximately month over month, and down 8.9% from April. Again, nothing significant in the change there. Montreal had a big change in the single family. It was down almost 5%, 4.7% month over month, and that equates to 12.1% from the April high, or 70,000. So yeah, it's interesting to see Montreal there. They had a pretty steep decline in 1 month. And the condo market in Montreal, nothing changed, 0% month over month, and 7.3 from the peak in June, or 30,000. I threw in the days on market there. So of course, days on market was, at rock bottoms there in the summer, and it's starting to creep up again now, which is expected with the slowing sales. So that's it for the stats. I didn't have Halifax or Edmonton. Their data wasn't out. It's the 7th of October, or sorry, 7th of November now. It wasn't ready, so I couldn't bring it to you this week. So one thing I want to quickly touch on this week before I leave is the announcement of having 500,000 new immigrants per year by 2025 by the federal government. I'm just going to touch on this briefly. Of course, this is all to do with filling jobs or pumping up the economy, in my opinion. It's not going to benefit housing at all. It's just going to put more pressure on housing. So just a quick sample of some data here. The historic average, here it is. It looks like it was between 200 and 250,000 per year since like the 90s or early 90s. So we're aiming for double that. So that's a pretty big number. And just in the last few years, 2019, we had 341,000 new immigrants. 2020, we had 184,000 new immigrants. And 2021, we had 405,000 new immigrants. And the average immigrant brought in $47,000 in savings. So again, I'm going to be analyzing this more in depth next week with housing starts, housing completions, the increase in, new immigrants, and of course, the average income or the average savings that these immigrants are bringing, just to touch on everything and how it's going to affect our GDP. This, again, in my opinion, is just a ploy by the government to prop up the economy because they know they've used all other options with quantitative easing and money printing and whatever else they've done. And it's going to negatively affect housing. Not going to say that it's going to drive prices up right now because I don't believe it will. But I just don't see how these new immigrants are going to be able to afford a place to live, or, when they get here, $47,000 in savings is, a down payment maybe in some cities, but with the interest rates, that's pretty high. And, 30,000, 35,000 is just going to go to rent in the first year. So it'd be very interesting to see how this plays out, but I'm going to get into it in depth in my next video. I've done it before in previous videos, but I'm going to do an updated one with these new numbers, and we'll see how it works out and then what kind of effect it will have on the housing numbers. So thanks for watching, and until next week, I'll see you then.